Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Global Tech Sell-Off and Market Volatility Update, June 23, 2026. This video presents a direct, informational narration of the source document. All right, let's dive right in. On Tuesday, June 23, we saw a massive, large-scale sell-off across global tech stocks. Now, everyone was kind of sitting on their hands waiting for Micron Technology's earnings report to set the market's direction. But the South Korean market, it preemptively took a dive. We saw Japanese and South Korean stock markets pull back collectively. In fact, the South Korean Kospi Index, which is widely considered a major bellwether for AI hardware, fell so hard it actually hit its circuit breaker. Heavyweight stocks like Samsung and SK Hynix, they both completely plummeted, dropping by more than 12%.
So, here's a quick look at what we're covering today. We'll start with that Asian market drop, then move on to the US market reaction and macro indicators. After that, we'll look at FX and Fed policy, check out institutional positioning, and wrap things up with some specific corporate updates. Let's get to it.
So, what exactly triggered this drop in South Korea? Well, just yesterday, SK Hynix's market cap briefly surpassed Samsung Electronics. Some traders definitely interpreted that as a flashing signal of market overheating. And really, several factors stacked up to cause this sharp decline. First, the Yonhap news agency put out a report saying lawmakers are discussing taxing unrealized gains on stocks and real estate. Then Daishin Securities noted that SK Hynix is actually slowing down its HBM4 capacity to shift production back to higher-margin bulk DRAM, all while HBM4 is still waiting on NVIDIA's certification. On top of that, there were reports downgrading production forecasts for the Rubin architecture, which obviously hit NVIDIA negatively too. Citrony Research also pointed out that SK Hynix's planned ADR listing was facing delays, and the fact that South Korea wasn't included in the MSCI Developed Market Index really triggered a wave of disappointment. Now, quick note here, the source document does mention they couldn't find official reports confirming that ADR delay, but the context is absolutely crucial. The South Korean stock market had recently built up these massive profit positions from the AI chip boom, and leverage was everywhere. Regulators had even warned about industry overheating to prevent systemic risks. So when these rumors hit a highly sensitive, elevated market, it quickly spiraled into a cascading sell-off, triggering those circuit breakers and completely liquidating margin traders.
Naturally, this risk aversion spread to Wall Street like wildfire. Even during the U.S. pre-market, major tech stocks were showing significant declines. Once the opening bell rang, we did see some dip-buying funds jump in, briefly pushing prices up. But 0 days to expiration, or 0 DTE, options traders aggressively faded that rally intraday. They really pushed the rebound down amid some intense capital volatility. Ultimately, all three major indices closed lower. The Nasdaq dropped 2.21%, the S&P 500 fell 1.44%, while the Dow Jones essentially finished flat. Interestingly, if you look at a sector heat map, it showed an even split of red and green. This tells us we're looking at rotational flows rather than just a broad-based systemic market crash.
Now, looking at volatility, the VIX index surged a massive 18% intraday, actually breaking above that key 20 level before eventually pulling back. The source document notes that this sudden spike from institutions lines up perfectly with previous assessments pointing to short-term downside pressure in late June. And we have upcoming risk events that could cause even more VIX spikes, like Micron Technology's earnings report after Wednesday's close and the crucial PCE data coming on Thursday. Meanwhile, let's talk about gold, because it is under clear pressure. It dropped below the $4,100 per ounce mark intraday. Since the Middle East conflict broke out back in late February, gold has cumulatively declined over 20%. That means it has officially entered a technical bear market. So what's driving this drop in gold? Well, market fears about further Federal Reserve rate hikes this year are seriously intensifying. Institutions have been downgrading their gold forecasts, and that's taking a real toll on market confidence. Now, a recent pullback in oil prices did provide some temporary support for gold, but the strengthening US dollar completely offset that effect. And the dollar just keeps climbing because of those elevated Fed rate hike expectations. Right now, traders broadly anticipate that gold is going to consolidate within a range of $4,000 to $4,300 per ounce, at least until we get new data that either confirms the Fed's hawkish stance or totally reshapes the monetary outlook.
Over in the currency markets, the Japanese yen is still sitting at really low levels. Interestingly, Japan's finance minister and U.S. Treasury Secretary Bessent had a one-hour call where they agreed that, and I quote, bold action may be needed. So traders are now watching like hawks for any signs of exchange rate intervention. Here's the big takeaway. A significant portion of this U.S. tech stock sell-off is actually being attributed to institutions selling equities to raise cash and lower their leverage on yen carry trades. This dynamic is super comparable to the U.S. stock market drop we saw in July and August of 2024, which was primarily driven by the large-scale unwinding of these exact yen carry trades. Though, to be fair, current markets have already baked in expectations for continued Bank of Japan rate hikes.
Let's look at the technicals for a second. The S&P 500 index opened with a literal gap down. It did manage to find some weak support at the 50-day moving average, but it ultimately closed below all of its short-term moving averages. The daily chart produced a really long upper shadow, which indicates some heavy overhead selling pressure and suggests that this risk might not be fully flushed out yet. If we lose that 50-day moving average, we should expect further downward testing. However, the source does point out that downward gaps like this are typically filled within 2 to 3 days or sometimes up to 2 to 3 weeks. You see, these gaps are usually caused by short-term irrational panic or leverage unwinding, and then your long-term value funds and passive index funds usually step in to buy the dip.
Now, what is Wall Street saying about all this? Honestly, strategists are sharply divided on where the market goes from here. On one side, you have major banks like Goldman Sachs, Citi, and Morgan Stanley downplaying the sell-off. They're sticking to a bullish year-end target of 8,000 for the S&P 500 and telling clients to buy the dip. But on the flip side, Bank of America is notably bearish. Their quantitative strategy team, led by Savita Subramanian, is explicitly advising clients to take profits. They point out that their bear market signal indicator has shot up to 70%, which actually matches historical peak averages. Because of this, Bank of America is maintaining a year-end S&P 500 target of 7,100, and they're predicting 3 rate hikes in the second half of the year. The source document characterizes that stance as highly aggressive.
Morgan Stanley's MW has a really interesting take on this. They assess that the recent market weakness, the surging dollar, and the precious metal sell-off we saw after the FOMC meeting aren't policy errors at all. Instead, they believe this is the new Federal Reserve Chair Vorsh purposefully demonstrating a hawkish stance to rebuild credibility. Basically, this approach uses hawkish communication to force the market to reprice the interest rate path. It effectively achieves partial rate hike effects simply through tighter financial conditions. So this market drop is really acting like a stress test of Vorsh's policy bottom line. MW does warn, though, that leading up to July, the core market risk isn't immediate rate hikes, but rather liquidity tightening driven by expectations of the Fed reducing its balance sheet. So, according to the source, we should expect conservative maneuvering to continue until the end of June. But after that, liquidity headwinds should start to dissipate, kicking off a second phase of the bull market driven by Q2 earnings. Meanwhile, we've got to talk about the Philadelphia Semiconductor Index, which plummeted a staggering 7.9%. Previously popular AI hardware stocks in storage and optical communications like SDNK, MU, and MRVL took really heavy losses. Investors are citing major concerns over rising interest rates and questioning whether these massive AI infrastructure expenditures are actually sustainable. But, and this is important, the source notes that global pensions, hedge funds, and CTAs are net sellers this week. They're executing a large-scale profit-taking event. Pensions are moving tens of billions for quarter-end rebalancing, and CTAs are moving billions, with this rebalancing window staying open until June 30.
Right in the middle of all this collective deleveraging, the 3x long semiconductor ETF, SOXL, recorded its second largest historical capital outflow. At the exact same time, the 3x short ETF, SOX, saw its largest historical inflow on record. That is a massive shift. But despite the short-term cooling in AI hardware and the return of bubble burst theories, the underlying trend of building out AI infrastructure is still viewed as totally irreversible in the coming quarters. I mean, huge companies like Anthropic and OpenAI are still in the pipeline for public listings. Ultimately, the current price action is being assessed as high-level profit-taking and leverage clearing that's capitalizing on the Micron earnings window. If the broader trend holds, this could provide some really strong potential opportunities for structural dip buying.
All right, let's look at some individual corporate updates. SpaceX's stock saw a slight rebound, hitting a low of $147. Interestingly, Cathie Wood stepped in and bought 210,000 shares, valued at around $32.5 million, though the source notes there's a good amount of contrarian skepticism surrounding that purchase. Keep in mind the stock is scheduled to be officially included in the MSCI Global Index and Russell 1000 on Monday, June 29, which will force passive funds tracking those indices to buy in. Right now, it holds a short interest of roughly 5 to 7%. Elsewhere, the quantum computing concept stock INFQ surged over 12%, and IBM rose more than 5%. This jump is being attributed to promotional momentum from Trump. However, the source cautions that liquidity-driven moves like this might be short-lived, as hot money tends to exit fast when liquidity tightens. Finally, wrapping up with some specific corporate earnings and equity dilution events. CBRS reported its first post-IPO earnings, showing Q1 revenue of $190 million,
up a massive 94% year over year, but it still missed expectations with an EPS loss of $0.22. They also announced a massive multi-year 750-megawatt agreement with OpenAI valued at over $20 billion. Wedgebush maintained a target of $270 for them, though there's skepticism there due to the heavy overhead supply of trapped positions. Meanwhile, AMC Theaters fell 24.6% after announcing a direct offering of 95.25 million shares to raise $200 million. This move is being assessed as essentially extracting liquidity straight from retail investors. And then there's U.S. infrastructure contractor Prim, which plummeted 40% at the open. Their core solar business reported consecutive quarters of cost overruns and delays, plus they had key executives leave, including their division president and COO. This prompted some very strong warnings against trying to buy that decline. So leaving you with this thought, with rising rate fears and drastically varying institutional outlooks, will the upcoming July earnings season actually validate all this massive AI infrastructure spending, or are we facing a broader fundamental shift?